The 2013 federal budget contained only a few new measures and largely reconfirmed a number of announcements that have been made recently by the government. The key takeouts include, for personal taxation, an abolition in some minor tax cuts that were proposed from the 1st of July 2015. Now, because these are proposed, they wouldn't have impacted anyone's hip pocket, but they won't be going ahead in the future. One heavily publicised measure was an increase in the Medicare levy, which is increasing from 1.5% to 2% from the 1st of July 2014. This is being introduced to pay for the National Disability Insurance Scheme and will impact many Australians. The net medical expenses tax offset will be progressively phased out. For most people, this will come into effect on the 1st of July 2013. However, for those who are in aged care facilities or suffering a significant disability, this will finally be abolished by 2019. The baby bonus will be abolished from the 1st of March. Now, it will be replaced by a payment of $2,000, which will be paid only to Family Tax Benefit Part A recipients for their first child, and they'll receive $1,000 for subsequent children. The threshold at which you receive Family Tax Benefit Part A is going to be frozen, as will the childcare rebate threshold, which is currently $7,500. Within the superannuation environment, there have been quite a few changes, but these have been very widely publicised. The first is an increase in the concessional contribution cap, which is the amount you can contribute to super on a pre-tax basis. This is currently $25,000 for everybody, but will increase to $35,000 for those who are over 60 years of age from the 1st of July this year. And for those who are over 50, it will increase on the 1st of July 2014. This means you can get more money into super on a pre-tax basis, and it's a fantastic incentive to save. There will be a reduction in the superannuation concessions for those who earn over $300,000 a year. Rather than paying only 15 cents in the dollar for concessional contributions, these people will pay 30 cents in the dollar. In another widely publicised measure, those who earn over $100,000 in a single year in earnings on their actual pension funds will also be paying an additional amount of tax. Currently, that's a tax-free environment. Nothing is paid inside the pension account itself. That will increase to 15%, but only on the amount over $100,000. Now, to give you an idea of who this will impact, if you're earning 5% within your pension fund, you'd need to have a balance of about $2 million for this to have an impact on you. One additional measure which will simplify the superannuation system somewhat is that now excess concessional contributions will be taxed at marginal rates. This is where you go over your cap, the previously mentioned $25,000. And previously, these were taxed at the top marginal rate, so quite high, particularly if that wasn't your personal marginal tax rate. These will now be taxed at your personal marginal rate, and they can be withdrawn from superannuation. However, they will attract an interest charge. There will also be a change in the tax treatment of deferred annuities to give people an incentive to purchase these products, which provide some form of insurance against outliving your life expectancy. In the social security environment, income streams are going to be deemed from the 1st of January 2015. Now, this will be only for income streams started after that date, and anyone who's currently treated as having a pension that is not deemed will be able to have that grandfathered. For those who are receiving allowances, such as New Start allowance, there will be an increase in the income-free area to $100 per fortnight, which will allow people to earn more from eligible employment. And finally, one new measure, which is an incentive to downsize the home for ageing Australians. This will provide an exemption for up to $200,000 from the assets test, subject to a number of quite complex conditions. There will be a pilot for this, which will come into effect on the 1st of July 2014. One of the most important conditions is that home itself must have been owned for more than 25 years. The most important thing to remember with all of these changes is that they are yet to be legislated, so they're proposals by the government that may affect you in the future. If you'd like to know more, go to our website or alternatively contact your financial planner.